What I did during my PhD is something called agent-based modeling. Now, I've seen that you've also worked on something like that, and I'm sure we'll talk about that. But what I learned there is, so what I then did is I built these simulation models of sort of interacting agents, and they have a behavior. And, I thought about this, like what would be a realistic behavior? But what I noticed is that very often when I made such a system, so think about, like, I made an entire macroeconomy. So there were like households and firms and banks and a central bank and a government, and they all interacted with each other via set rules. I think that's a bit similar to how you have thought about before, probably, when designing this protocol, like how people will act. You thought about their behavior, and that's how you structured the incentives, I think. You will correct me later on this if I'm wrong. But what I noticed there is that because if a system is complex, meaning that if one party interacts with the other party, and then that party interacts, like even if the behavior is relatively simple, you can get very surprising outcomes. And so what I noticed there is, or what my instinct how my instinct around that developed is like immutability is horrible, because very often something happened in those simulations, and it might have happened only in let's say 3 out of 500 randomly generated simulations, that I never expected beforehand. And so, that's what we would call a bug, right? And then I had to update the system to accommodate that. But if you don't have that feature, how do you view that?
Yeah, that's a great point. Yeah, I think like the more interactions you have between agents, generally the more unintended consequences you're going to see, for sure. I suppose with Liquidity, there's not really that kind of high level of interactivity between the agents. It's like people are interacting directly with the protocol. Mm-hmm. And, a borrower is borrowing directly from the protocol using their own collateral. And they're not interacting with other borrowers per se. They can obviously sell their LUSD, but that's quite a simple interaction. It's buying or selling it.
Yeah, but I guess people who put money in the liquidity pool, who stake LQTY, or who borrow, they do interact in some way, right?
Yeah, they're taking a share of the pool for sure, and a share of whatever kind of rewards go to that pool. But they're part of an aggregate. But again, they're kind of they're not interacting directly with other pool members, I would say. But it's a great point about immutability. I think it's a trade-off, and it's a design decision. You lose something and you gain something from it. And we were pretty paranoid about just testing as many worst case scenarios as possible and doing as much modeling as we could do kind of for ourselves, and hiring external agencies to do that, and spending a ton of time on security and kind of crypto economic analysis and really trying to get everything right. So yeah, it is a trade-off, but you can also make the case for upgradability. Like upgradability itself with blockchain protocols actually introduces bugs, and it introduces more surface area for things to go wrong. And we've seen things go wrong when protocols have done an upgrade or a kind of new governance proposal, and things have broken like 2 days after the change. So yeah, that's also a risk as well.
Yeah, okay. So you're making sort of the argument like keep it simple a little bit. And then you also have less of this, the chance that something happens that's unexpected, like as I mentioned. I do agree with that. If I look back at my modeling adventures, the simpler models almost never really, didn't have that problem as much, for sure. That's definitely true. And you also use agent-based modeling, right, when designing this protocol? So basically maybe to simulate sort of some scenarios. Is that how you used it?
Yeah, so we did some basic modeling ourselves, but we also hired an external firm who were kind of experts in the area to really dig into it. And the goal for that was to stress test the system. We hired this company called Gauntlet, who do a lot of modeling for blockchain firms. And basically we wanted to see how does the system stand up under very high ETH volatility and under very high network transaction costs. And so they created a bunch of different agents with these kind of range of preferences for kind of risk tolerance and also I think response time. So some agents would react quickly to the ETH price, and some would never touch their position and kind of forget about it. Mm-hmm. And they did this big modeling kind of run with these parameter sweeps over all these different configurations, and found that they were kind of looking to see at what minimum collateral ratio do things start to go a bit wrong, and what minimum collateral ratio would be safe. And they found that the parameters we chose in the end, this 110% minimum collateral ratio, is very safe with a low risk of insolvency, very low risk. And they also found that the system would only enter something called recovery mode very rarely. And this is a mode of the system where it tries to kind of avoid becoming insolvent when it's getting a bit close to that level.
And how does the system get insolvent? I know it's an edge case, but does it happen when the price of Ethereum drops so fast, such that the liquidations don't come in fast enough, such that some loans have to be liquidated when Ether price is already below collateral value?
Yeah, that's exactly right. So that's really kind of how we define insolvency with liquidity. It's if the total collateral ratio, so all the backing of Ether against the total outstanding debt, if that ever falls below 100%, we could consider the system insolvent. And then, that's obviously a situation the system does its best to avoid. And as you said, it comes down to that comparison between how fast the Ether price drops and how fast we can liquidate to clear out the unhealthy loans. So liquidations are very fast in liquidity. And one thing we did was we looked at kind of the biggest price drop that can happen between two updates of the data feed for the Ether price. And historically, it's never gone above 10%. It's mostly like much lower than that. And so we realized that actually that's the margin you need for the collateral surplus in the minimum. So if the maximum price drop between two updates is 10%, we need a minimum collateral ratio of 110%. And actually, since we kind of did that analysis, the maximum price deviation has actually decreased because the data feed provider has got better with their kind of the way they provide data, basically. So basically, liquidations have to happen very quickly and clear out the bad debt.
Yeah, but first of all, I think it's this is when I read about your protocol first. I love to see that actually agent-based modeling has some uses like that, because in economics it never really got on, because from a scientific perspective it's not that interesting. If to build a very complex model to show something very simple, then sort of it ended up such that people preferred building a very simple model just to show some simple mechanism, basically. Then you can write a shorter paper. But I always had in the back of my mind, it would be cool to sort of stress test systems before they come online using an agent-based model, and then you can learn sort of where it might break. It might break if humans enter as well, but at least you maybe have sort of sniffed out 2 or 3 scenarios beforehand. So that's how you used it, right?
Absolutely, yeah, that's exactly it. Yeah, and there's always factors you can't control and irrational behavior you won't capture, but it is really good for catching some things, yeah.